All right, gentlemen, we are live. Our webinar has begun. Here with my two friends, Steve Zimmerman from North American. Steve, good afternoon here on the East Coast.
Hey, AJ, great to be with you.
Great to be with you as well. Rick Blaser, New York Life. Hey,
Hey,
Rick,
Anthony, thanks for having us.
how's it
Appreciate it.
going? So guys, I don't know if it was your name draw or what, or maybe it was just a hot topic, but this is one of our most well-attended webinars in history, in life brokerage history. Let's call it 250 registered participants. So, thanks for being with us today. This is a hotly debated topic, right? Like what's the best solution? And I think what we're going to uncover here today is a little bit about the mechanics, what's similar between whole life and IUL, and what's different between whole life and IUL. And Rick and Steve are going to keep it professional, but I think they're going to debate a little bit and have some varying opinions on some of the pros and cons of each product, right? I don't think there's any bad product, provided it's priced responsibly. We've seen some pretty ugly IULs in my career, and frankly, I've seen some pretty ugly whole life in my career, right? I mean, I've seen whole life paying 150% commission and H121 pay, and I mean, there's some ugly designs out there too, Rick, in the IUL world defense. We're going to get into why standalone IUL, why whole life, why wouldn't you buy a VUL with an IUL sub-account? What benefits do consumers get by participating with whole life companies versus in the private markets with bond alternatives? And then we're going to, of course, all roads lead to sales, right? Like where are we driving most of the premium in our whole life chassis, and where are we driving most of the premium sales in our IUL chassis? I will say that I own both products. Both have served me extremely well. This is a good and better discussion, and it's really a matter of public opinion, right? It's kind of like vanilla and chocolate. What's your favorite? What I can say though is that my friend Fabian Gonzalez, who's one of the best foreign national technicians in the world, for that matter, he said, if you want really nice clothing, you go to Italy. If you want really nice cars, you go to Germany. If you want really nice chocolates, you go to Switzerland. If you want really good life insurance, you come to the United States. So, I think our industry gets a little too hot and heavy on this topic. But if you take a step back and you look at the rest of the world, we still do issue the most solvent and competitively priced products in the world. So, let's keep that in mind. So I'm gonna take a second and share my slides. All right, we are in business. Okay, so I have spent a ton of time over the last several months, including attending a whole life masterclass, rebuilding and reconstructing and back-end engineering several different IUL products in anticipation of this webinar. And here's what I found. Both whole life and IUL are general account products. Okay. There's no question about that. Both rely on institutional bond portfolios, right? Both rely on asset liability management, and both rely on long-term investing. Okay. What the policyholder actually receives from that balance sheet, right? Because both sit on the general account of balance sheet of the insurance company, is fundamentally different. So, where I see some fundamental differences, and what I'm going to talk about is the surplus model of whole life. The surplus model in whole life is where the general account earns bond-like returns. And after expenses and mortality experience and reserve, surplus is created. that surplus supports the dividend. So policy owners get to participate in that surplus. So whole life policy owners, for that matter, participate in the bond economics directly through the dividend. Now, conversely, the IUL is built on a hedge, in my terms, a hedge budget model, where the general account earns bond-like returns. A portion of that expected yield becomes a hedge budget, and that hedge budget buys call options. So options determine caps, the pricing, interest rates determine caps and participations. So the policy owner actually receives an index linked credit, not a bond yield. So the economic flow is the general account creates the hedge budget, subject to options pricing, sets the cap participation, and it earns an index credit. So it's a very simple trade. The IUL policy owner does not participate in the bond surplus. They give that up in exchange for a derivative-based crediting funded by bond economics. Does that kind of that makes sense? So while both products sit on the same balance sheet, one transmits bond economics directly through surplus, and the other converts bond economics into option-based upside potential. So that, in my research, sets up and frames this entire debate, right? So when I use the term economic transmission, right? What is economic transmission? In my mind, I gain the most clarity by thinking about it as how does the money move from the insurer's balance sheet to the policy owner? Both whole life and IUL sit on the same general account, but the path from that general account to the policyholder is different. That path, that flow is what I call the transmission mechanism, economic transmission. So the real difference between whole life and IUL isn't the balance sheet, it's how the economics are transmitted from the balance sheet to the policyholder. So I'm going to tee this up with questions for both Rick and Steve. Is surplus participation versus hedge budget conversation a fair structural description between whole life and IUL? And I'm going to just take a moment and we'll start with Steve.
Okay. Hey, Anthony, I think at a high level, I think it's a fair comparison to say that they're starting from a similar place. They work a little differently. So if you look at the IUL side, as you teed it up, it's not a direct participation in the market. There is yield coming off the company's general account. That feeds into the budget that buys options, which allows the parameters, which sets up the return for the client. People know intuitively higher general account yield, more money coming over for the option budget. The other part of this, though, is the cost of options. When the market is particularly volatile, frothy markets, option prices are higher. So a higher option price may dilute what we can bring over into the budget. So you've got those two primary levers, yield off the general account, option cost. Those two in concert with each other generate that index or that budget for how much we can capture. But I think what I would just say, it's fun to see Rick here. These are both great products. I mean, they both do really good things. So it's a question of not one versus the other, but when do you use each one?
You're a gentleman, Steve. I can't wait till he strikes a chord with you and you fire back a little bit and get that fire in your belly. Rick, what do you think? How do you feel about the surplus participation model and the hedge budget model? Is that a fair structural description between of the differences between whole life and IUL?
Yeah, like Steve said, I think generally you can look at it that way. I think when you look at a whole life product in particular, I think I would actually say it's kind of bond plus in a way, because when you look at a portfolio of a whole life company, you're getting effectively the portfolio of the company into which you're investing. And then, I can speak for New York Life. We have, different businesses that we run at New York Life that also contribute towards the dividend. So you're getting not just the bond-like return, you're getting the bond plus, if you would call it that, from a practical perspective in the whole life policy. But it's falling through in the form of a dividend rather than in some other mechanism that would be used in an IUL product.
Okay. We're taking a step further, Rick. I'm going to keep this with you.
Mm-hmm.
we talk about the surplus model where the general account yields in the good years when interest rates are up, I mean, you create a surplus, you store that for later years. You get a little dividends smoothing, right? That's why insurance companies can continue to pay dividends to the tune of 5, 6, 7% in low interest rate environments. But really, doesn't it give the policy owner access to some institutional type options where the insurance company holds to maturity discipline, and you're not subjected to daily market fluctuations? Isn't it true that the policy owner gets access to these types of preferred treatment that they couldn't get access to in the private markets?
Well, you'd have to build. I mean, New York Life's got a portfolio of investments that you're getting access through towards the whole life product. Okay, I think is kind of where you're going with this. But ultimately, what we have is so diversified and basically has access to every single asset class in the marketplace that most people wouldn't have access to from that standpoint. But to match what we have, you not only have to have that portfolio and that mix of investments, but also you'd have to have businesses created that would also generate returns. Because if you just looked at just the portfolio over the last 10 years or so, right, we've been through an incredibly low interest rate environment. And it's been the other things at New York Life, particularly, and I'm just speaking for New York Life, but it's been the other things with the insurance carriers. They're helping to drive the dividend growth or the dividend performance to smooth out those returns over those years. Otherwise, you'd see a much more rocky environment that's there.
Yeah,
It's just an incredible, the way that the investments are structured, they're designed for long-term performance. So we invest in a certain way that would be appropriate for an insurance product that most people are not investing in that manner.
yeah. How cool is it though, Rick, where you can get through whole life, you get access to investment grade corporates, infrastructure debt, government bonds, real estate equity, policy loans, right? Structured ABS, other business lines. Like, I mean, New York Life is no slouch in the group market and the annuity market, right? A private investor would have to recreate all those business models to be able to participate in something similar.
You realistically couldn't do it. So I mean, you realistically couldn't do it. So that's the beauty of having the whole life product in the way the investments work within it.
Yeah. Yeah. Steve, I'm going to toss this to you. We talked a little bit about the hedge model. Would you say that, is it fair to say that IUL policyholders do not participate in surplus? And do you agree with the statement that they trade that in exchange to receive what the options buy?
Yeah, absolutely. I mean, there's a few misconceptions that, this advisor group here, we want to go in the weeds today a little bit to give you a little bit sharper expertise. When you're speaking to clients, even really intelligent clients, you don't want to get too deep in the weeds because you're going to confuse them. That's our objective today, is to give you that foundation to be able to speak from. So on the index side, that's absolutely correct. This is not a direct participation in the market. People oversimplify at times and say that if you're buying S&P or an index, you're getting the index. It's really not true. Based on those levers we talked about a minute ago, we're creating a budget. It's impacted by interest rates and options cost. We're going to then say you're going to get, of those indexes you pick, whatever percent or whatever parameter is as the return. I would say this is not really a bond equivalent. It's certainly not an equity equivalent. If you think in terms of, whether it's sleeves or whether it's buckets of money, asset allocation, to me, this would almost be like an additional asset class. Those of you that do investments, stocks, bonds, and cash, it's my pie. What's my percentages? I would say here, life insurance and maybe an IUL is a fourth asset class. It's going to give you, I would say, maybe a between position between equities and bonds. So I'll come back into it a little bit more detail later. The evolution in product. And I would just say, I'm thrilled to be here with Light Brokerage. These guys are the best. They've got some of the best products in the market that everybody has it, and everybody else has out there. Their team is the best. What I would say is historically where have people gotten into trouble. I pick my favorite product. I pick the illustration index that illustrates best. That's what I go sell. That's how we think we're going to win the sale. That's where everybody gets their nose bloodied here. If you look now on a go forward basis, what people are doing is we're using different kind of indexes. We have indexes through North America, and why I'm pumped to be here. 3 things to keep in mind. We've got some of the highest participation rates paired with the highest guarantees in the industry. It's 200, 300, and 400% participation rate. Okay, in English, what does that mean? What that means is the rate of return I earn. If I earn 2% raw index return with a 300% participation rate, that's 6. Pair that with guarantees, you take a lot of the risk out of it. We've got other things, maybe we'll have a minute to get into. We have uncapped options with a spread, 5.2%. You get everything over 5.2. We've got an uncapped option with a 64% participation. You get everything and you get 64% of it. Those 2 options, guys, over the last 10 years have almost returned what the S&P did. We've got a couple of other things that I'll share. I don't want to give you everything now. So using those in conjunction with each other with a little bit more restraint on illustration, rating or rate of returns, that's how we're doing it right now.
Steve, well said. So, the advisor should be thinking about the fact that caps are a function of option pricing, right? Which fluctuates with interest rates and volatility. Rick, I don't mean to put you on the spot, but I like to play devil's advocate a little bit. And I'd ask Rick, as a whole life, right, expert, Rick, in what scenario would you ever consider IUL? Right? This is hotly debated. This is coming from a whole life guy, and his response was cost. Right? And when IUL was created, you traded guaranteed elements for lower cost because the consumer now bears some additional risk. Right? They've assumed some of the risk, and with that risk comes opportunity. There is a possibility that you can receive some additional performance. Rick, would you want to expand on that commentary?
Yeah, I think generally speaking, with a whole life product, regardless of the carrier, it's going to be more expensive in most cases than a whole life product than an IUL product would be. I'm sorry, with respect to raw premium to death benefit, at least initially, from what I've seen. Okay, so on a base number, so obviously if the New York Life or any whole life product is based off of guarantees and what we need to charge in order to guarantee that death benefit, regardless of the future circumstances in the equity markets or financial markets or the world for that matter. Okay, we've come up with a price that we think is fair for that. Okay, and if the client's willing to say, okay, I'm willing to take some risk, I don't need to be as certain as I would be in a whole life, I'm willing to take some risk, then of course there should be a reward for that. The reward is a lesser premium, right, for taking that risk, and that's I think where you end up. And so depending on the clientele you're working with and what the motivation of the client and what they're looking to do, sometimes a whole life product doesn't fit the budget versus what an IUL product would do. And that's when you got to look at different things. But clients have to understand that I would think on the spectrum, a IUL product is significantly more aggressive than I would say than a whole life product would be. And there's nothing wrong with that. Clients just have to understand the risk that they're taking and understand what comes with that piece for that to work.
Yeah. Rick, I'm going to keep it with you, and then Steve, I'm going to come back to you. So you talk about risk or de-risk, and there's been several reports that have come out. I mean, even Morningstar put out a piece that's several years old. But what whole life represents is kind of slow and steady, right? And with a standard deviation of 1.9 between the years of 1980 and 2025, and an average dividend income rate of 7.9. What that means, that standard deviation, what that means is 1.9%. It's how far it moves from the mean, how far it moves from the average. So if you think about this, like I have big kids and I have little kids. I take the little kids on the dinosaur roller coaster at Storybook Land. That thing barely moved. Like you might have a little drop, a little lift. I mean, but it's very steady. It doesn't move far from the mean. When you get into the S&P and some other investments, there are larger ups and downs, right? You kind of even get into the loop-de-loop, a great adventure type roller coaster. So you are you move very far from the mean. So if you look at whole life as a standard with a standard deviation of 1.9, you're looking at consistency where a bond index is at 7.1, and Barclays has the oldest trackable bond index, and there are negative years, right, in bond funds. So there's a lot of stability when it comes to whole life. Combine that with access to institutional type investments and preferential tax treatment and smoothing. You get a really cool asset class that you couldn't get otherwise. Steve, now it's a little more difficult to. I want to bring this back to you. It's a little more difficult to talk standard deviation and consistency with IUL. And admittedly, our industry has gotten a little aggressive, right? We've been through asset-based charges, we've been through multipliers, we've been through so many different iterations, and I think we've learned a lot. But talk to us a little bit about how you stress test, how you've overcome some of the objectives of volatility with guaranteed elements. Even a guaranteed income story that folks on this call may not be familiar with. It is very unique to our industry and certainly to IUL.
Okay. Hey, Anthony, thanks. Hey, great teeing up. I think if I had one thing that I could share with the group today, it would be unpacking what you just said. I mean, IUL has been a workhorse product for many, many years. It's done great things. It's also taken a bit of a black eye at times. I think where the product has gotten into trouble has been the advisor not explaining it correctly, overpromising, under-delivering, selling it with too aggressive expectations, not going back and looking at it. So where do we come today? And I think I'm still going back to the whole, IUL versus whole life. We're always trying to pigeonhole life insurance to put it in the right place. What's the best product? We don't do that with AUM for investments with clients. A lot of your clients have different, similar goals, but they get there a different way. So what I would say is the IUL has a little bit more risk, a little higher upside. Your clients, if they're a little bit older, have less risk tolerance, whole life all the way. The opposite may hold true for IUL. So let's go back to this. Over the years, we've gotten to be taking advantages of new product advancements. There's different index introductions that I mentioned a few minutes ago. It's different indexes that reduce the rate of return you need to produce in the index, the raw return, to create what the illustration says. Okay, in English, meet or beat client expectations more often. The second thing is by diversifying, you're de-risking that index. Now here, this program, this sheet or modeling that Anthony is showing us, this is a program that we make available to Life Brokerage. You see here, it's a modeling program. Columns 6 through 10, we're importing the life insurance numbers. Now, isn't it common for people to say, hey, I don't know about that life insurance stuff. It's a bad investment. Very common. We can quantify for you in a couple of different ways to show life insurance is very efficient. So if you look here, this is a tool that says, let's take our life insurance illustration, let's produce a parallel cash flow model, and we're going to drop it into some other assumptions. Column 1 through 5 is saying a hypothetical, any taxable investment. What we can do here is we can show you same money going in, money growing, and then at later years, we can show money coming out. The money usually lasts longer in life insurance just because of the tax treatment. You're taking $1 out to net $1. On the investment side, you're paying taxes along the way. I wanted to show you this report because the crew at Life Brokerage or our team over here at North America, we can run these for you all day long. It's an infinite set of ways you can customize this. It's a really great tool for you to use for yourself or for some of your clients. So the last thing I would say is more recent product enhancements, guarantees. I mean, guarantees has never really been something we talked a lot about in the IUL context. What we've done is we started to take some new guarantees and put them in play. The product that we were showing you here is a Nexus product that we've made. It's a special custom product we've only made available to a handful of our best relationships. Life Brokerage and Anthony are one of them. Another reason why you're in a great place here. We're putting guarantees on that product that you've never seen before in the life space. The one thing we've done is if you think about how a life insurance illustration looks, there's cash value, there's surrender value, there's death benefit. We're adding another column and it is a guaranteed benefit base. What we're doing here is we're multiplying the interest credit cumulatively over time by a contractually guaranteed 150%. That is going to produce a larger number of dollars compared to the policy cash value. We're going to take that larger amount and we're going to be able to leverage distributions or liquidity in different ways. We can run guaranteed income off of that contractually guaranteed benefit base in ways you've never seen. It'll look an awful lot like annuity distributions, and we can make them guaranteed off the life policy. So, Anthony, I'll stop there. I could go on, but I won't keep going. But just know, gang, we have ways with guarantees. We can run these IULs. We can run you guaranteed income that is like you've not seen before.
Yeah, I'm going to take this a step further. So if you really want to truly stress an IUL, you first of all, you choose one that's built with low charges. That's number one. Number two is you bring it down at least 100 basis points off the historical, right? You want to you want to under promise and over deliver. What Steve is talking about is a guaranteed income rider that if this particular client wanted to trigger that privilege, they would then trigger $85,000 of guaranteed tax-free lifetime income from that point forward. The guaranteed tax-free lifetime income, the benefit pay rider, actually exceeds 5.5% crediting in standard loans, right? Fixed loans of 81,000. So you talk about de-risk, and here's a perfect example of how to de-risk, right? The modern day, let's call it modern day IUL. Steve, any other comments on that?
Yep. The only thing I would say is we've got cash value of $1.3 million. The benefit base here is $1.6 million.
Right.
That's the number that we're going to guarantee the income off of. It's contractually guaranteed. You don't have to use it, but it's a nice way we throw the guarantee word in where we haven't typically seen. There's other features where you can actually get liquidity. You can take that $1.6 million if Social Security goes down. It's a trigger to get significant liquidity there. So just what I would say is if this intrigues you and it's something you haven't seen before, give the crew at Light Brokerage a call after.
Appreciate that. So there's two. So we just covered two important points, right? We talked about the predictability and stability of whole life. We talked about how IUL has taken a step back and embedded some guaranteed elements. I'll show you another one later in the presentation. So I'm going to toss this to both of you. Which product chassis, gentlemen, and Rick, we'll start with you, is a better solution to use in leverage strategies like premium finance?
Well, you're asking the whole life guy which one's a better strategy to use, right? So it's kind of a loaded question here, but I think one of the things that I think is very important in the premium financing context is that obviously adding on a financing component to any life insurance deal adds additional risk and different variables that have to be looked at, right? And one of the things I think in what a whole life product does on the guaranteed side of a whole life ledger, there's going to be cash values in that product. Generally speaking, the product used in a financing space is a 10-pay design for the most part, 10-pay or shorter design. And so one of the things that is important that we can point out is that on the guaranteed side of the ledger, your cash value is going to be equal to typically your premiums paid, which would be your non-accrued interest loan value, let's say, right? So if you just paid the premium and borrowed the premium, paid the loan interest every year, the guaranteed cash value in year 10 would equal or be more than perhaps the loan balance. So you can de-risk the premium financing strategy because you know that the principal risk is kind of out of the situation, right? Because if you keep that 10 years, there's going to be enough cash value there on a guaranteed basis to pay off that loan. Now you may not get, the interest may end up being more than you thought or less than you thought, right? But I think most high net worth individuals understand the interest rate risk component there. What they don't understand is, hey, I bought this policy and for whatever reason, all of a sudden I have to pay back a big portion of this loan that I never thought I'd have to pay back on this deal. So I think that's one of the things in a whole life product that helps a lot is that the guaranteed cash values provide that certainty there that you're not going to be underwater significantly with respect to the loan unless you decide you want to accrue interest and then things kind of go from there. But I think clients understand the accrued interest is going to build up the loan balance situation.
Yeah. Steve, same question. The premium finance chassis. What do you like and why?
Interesting. And again, it's all a question of risk, client's risk tolerance. We see both whole life and IUL being used in the premium finance setting. So if you have a client that just doesn't have the risk tolerance. Love the whole life idea. Where what we're doing, and it goes back to that whole concept of the IUL doesn't have the same guarantees, but if we can design it where we can de-risk it, I love that phrase. If we can reduce the rate of return that we have to make or have to return or earn to make this work. The name of the game of premium financing is having enough value at some future point in time to pay the loan back. And so what the two things I would say here, where IUL sings, is those index allocations where we reduce the hurdle rate, the amount you have to earn to do what the policy is designed to do at the time of illustration. But also some of these products, like our IUL has a 2% guaranteed minimum account credit, not a 2% credit yearly, but every 10 years, if you didn't earn 2, we're going to true you up and add money to your policy had you earned 2. So I'd say where IUL would look appropriate is if a client has the suitable risk tolerance, if we can demonstrate and stress test that illustration, run it at lower rates of return, run zeros for different numbers of years just to show how it works, then I think it works really well here. So this is one of the best examples of under promise and over deliver.
Yeah. A question from the audience is somewhat timely. With all else equal, and Rick, when can whole life outperform the IUL, assuming you're getting a full cap rate credit versus a 5% average whole life dividend?
Well, you'd have to look at the numbers, but if you're assuming the illustration is getting a full cap credit every single time, and that means you're succeeding every single time in the IUL year over year, right? Which would probably be an unusual, let's say, outcome, okay, at best in that scenario. But I think one of the biggest issues with a whole life product versus an IUL is sequence of risk, right? Sequence of return, sorry. And with the whole life product, your returns are sequentially going up each year. You're getting increasing positive returns. I think in IUL, you're going to have years where there's up years and down years and so on and so forth, right? And they all have to kind of balance each other out, or however that works out on that structure. But I think so the question is, I think the answer is, I don't know that it would if you hit the caps every single year in IUL. I think it'd be hard to believe that a whole life policy would beat that if you were going to hit the maximum cap every single year in IUL. I think that was what the question would be, right?
Yeah. Yeah. It's maybe a bit unfair, but just in general, Steve, when will IUL outperform whole life?
But I would say it would outperform, guys. And the question a second ago, we should never assume that it's going to hit the cap every year. I mean, it's really nice. It was a great question. In my mind, when I'm showing this to people or sitting with clients, I try to say, look, let's be honest. Here's what it would do, and let's back off from that. So this will be an outperforming situation if we've set expectations with client. We've allocated among the indexes the right way. We're capturing, with the uncapped options, we're capturing the maximum upside. We have some other indexes that still credit in lower rates of return. So if you think about in down markets, we have indexes that credit well. In kind of those middle frothy markets, we have indexes that capture the credit well. We've got uncapped options that capture the big swings. So where this will work well is if you're diversified in your indexes and you're kind of got a winning footing in all different market conditions. And now granted, that sounds wonderful when I'm saying it, but it also has a certain amount of risk or variability is better than maybe saying risk, that when you set expectations with clients, if they understand what it is, they're willing to accept that it could work better there. I don't know if we're going to have some time to get into living benefits. We had chatted before about, the whole accessing living benefits for things like long-term care. IUL and whole life do very different things, and they're both really great options in that setting too.
Stick with us. We're going to stay on the technical discussion for a little bit longer, and then we're going to move into some sales concepts. And Rick is going to introduce a concept today that I think is going to blow your mind. Steve's got something to share with us that's going to capture the broader market. Rick's is a little narrow, niche market, but something extremely unique that I don't think has been publicly announced just yet, and today may be the first. So let's stick with Rick. If whole life transmits the bond economics directly, does that limit upside capture compared to a derivative overlay like an IUL?
I don't know that that would be the case. I mean, I think the expectation, kind of the overview expectation of the current environment that we're in, is that something that's a derivative would outperform if it was successful every year. Let's be clear on that, right? A successful derivative every single year may outperform a consistent bond portfolio. Okay, I think you have to look at what the likelihood of that is every single year to do that. So I don't know if that's really the fair answer to your question, but I think that at the end of the day, what you're buying with whole life is you're buying consistency and predictability, right? And you're eliminating sequence of return risk, and you're creating peace of mind. And that's what you're buying with a whole life product. Okay, IUL brings a different set of values, a different set of options, if you will, to the client for what they're trying to do. So I think comparing the returns, I mean, theoretically, there is no cap on a whole life product. Okay, theoretically, if New York Life blew the doors off its financials for the next 200 years in a row, okay, would it beat an IUL? I have no idea, right? It depends on a lot of different things. But at the end of the day, there's no cap on it. But I think if you ask people, hey, what do you think a reasonable bond-like portfolio is going to be over a long period of time? Okay, and then what do you think in I don't know how to best say it, hedged IUL strategy would be over a period of time? I think people are going to have different ideas of what they think that's going to result in. But there is no cap on a whole life product technically.
We appreciate that, Rick. So we're going to move into some this different discussion where we're going to talk about concept, sales idea. Steve, there's been significant amount of criticism and negative publicity around IUL. From your professional experience, what are the most common misconceptions about IUL?
Hey, Andy, thanks for teeing that up. I was reading this in the chat, so I really wanted to take a minute and address this. Hey, IUL gets a lot of attention, and when there's a high-profile case, like obviously we saw in NASCAR not that long ago, there was a big case that drew a lot of attention. There has been a lot of publicity. I mean, it's a small number of cases; they're high-profile. Everybody latches onto them. I would suggest that there's a host of other cases where policies have been sold really well. So what I would say is, where have we gone sideways here? The first thing is, I see a lot of agents or advisors, they're selling IUL. There's a fear, a fear of missing out. I got to show the best illustration. I'm not going to get the sale. They pick the carrier they like. They pick the index they like. They run it with a max illustrated rate. It might get the sale, but then a lot of times, I mean, we're not day trading things here. We're not day trading stocks. We don't have to manage this daily, but you should go back maybe every year and look at it. We get into trouble where people sell an illustration that has unrealistic expectations. We sell it on the client expectation that this is guaranteed for life, it's never going to change. And then the advisor never goes back. Now, there's moving parts in this. So there is complexity, but when you get into what this is, and it's great that we're here today, if you understand the levers of how these move, it's really not as risky as people might want to portray it as. What are the moving parts in an IUL? There's the index we've been talking at length about. The index is funded by the option budget, which is the options cost. It's the yield off the general account. There's other policy charges. There's COIs, cost of insurance. There's some other internal charges. The majority of those charges are not touched or manipulated by the carriers for profit objectives. The thing you might see in a life policy in an IUL is the caps and participation rates may go up and down a little bit. That's the part that most people don't explain to their clients. It is a slow-moving deal. The interest crediting on a life policy is based off of portfolio crediting. That's a longer-term interest rate assumption. New money is what you'll see coming off of annuity general accounts, where it fluctuates every day with the new money coming in. So, I would say that, that's probably where we've seen some of the issues. If you explain to clients that way, you don't oversell the illustration, you don't over illustrate it, you stay in touch. The only thing that I've seen probably problems is, I see people that sell big cases. I get a call 3 years later and they're frantic. Steve, I'm getting in-force illustrations based on what we sold 3 years ago. It doesn't look like what I sold to my client. That's because you might have done all the stuff I just mentioned. If you're working with a life brokerage team and you're selling it in a more prudent way with index diversification, stress testing and backing off of rates, staying in touch with the client, I think that's the formula for success. And you're not going to see those problems.
Well said. We shift gears just a second here, Rick. If interest rates go back down, Rick, what and dividend scales decline, what protects policy owners from long-term disappointment?
Well, I think the long-term disappointment would come from perhaps not getting the dividends they had thought they were going to get. But if you look at the last 15 years, we just came off historically low interest rates coupled with a global pandemic, and we ended up pretty good in the face of that, right? So I think realistically, the whole life dividends, the whole life products are priced where they need to be from that standpoint. But I would also say there's a beauty of a whole life contract, which is the fact that if, unlike other products, if the dividend is not paid, nothing happens. Okay. Your policy, it may not get the return you thought it was going to get, but it still works. Okay. As long as the premiums are paid, and the vast majority of the stuff that we're selling at New York Life these days are limited pay products. So you may pay a product for 10 years of premium and then never have to pay again. It's going to keep trucking along doing what it's supposed to do. And if the dividend is not paid that year, so we have a systemic long period or 1 year of a historically bad situation where there's no dividend, the policy still goes fine, right? That said, New York Life and part of the peers have paid dividends for, I think we're at 172 consecutive years. So I don't know how many we're going to miss in a row. But when you look at guaranteed ledgers that show no dividends forever, it's probably an over exaggeration of what's it look like. But the point is, what the takeaway here is that with a whole life product, if you have a bad year, okay, it doesn't negatively impact your life insurance policy at all. The only thing that it does is lowers the expected return on a going forward basis based on the fact that you didn't get as much of a dividend as you thought you're going to get that year. Yeah. So it's not disastrous in a stretch.
Manageable, right? Manageable.
Right.
Offset scenarios maybe affect
depending on what you're doing, but it also matters because that can happen at any time, right? So if that happens when the client's 85 years old, it doesn't make a difference on a whole life contract. If it happens at 85, 86, 87 years old in other types of contracts, it can have a big impact when the COIs are very high at those points in time, and the clients probably can't get reinsured again.
Yeah. There's that standard deviation question. Steve, any response to that?
No, I don't really think I have much to add, but I'm looking at the questions, Anthony, and I just want to maybe take a second and just maybe hit a couple of the things that are in the chat box. So I see one, and Steve Fishman, thank you for the question. I mentioned 2% rate of return, 300% participation rate, and they could go down. So really good question. I mean, you're kind of calling things out with what you might be thinking or the consumer might be thinking. So in my mind there, the 2% rate of return, it's an extra guarantee. It's a safety net. Now, when I did mention the 300% participation rate, and if you earn 2, you get 6. It could go down. We've worked with a Nexus for 20 years, and they've never backed away, and they've always honored the participation rates. Now, like we say, that's no guarantee going forward. The underlying guarantees on that one would be 125 basis points. It could go down to that. It may not, but it could. If you look at underlying guarantees on other really good name brand IUL companies, their underlying guarantees are 5 basis points, 30 basis points, 50 basis points. So it's all relative, but great discussion. And what I would suggest is it goes back to validating the need to diversify your indexes. I could show you an illustration, 100% on the 300% participation rate. It would kill everybody. But then in reality, I'm setting myself up for a lot of pain down the line. So I would probably allocate under different indexes. I might put part of my money into that 2-year, 3-year index, but I'd probably put a bunch of money in some other places too and minimize the risk. But thanks for the question.
Well said. I'm gonna just touch on just one point that I also have uncovered in my research, right? So we said that both whole life and IUL are backed by the insurer's general account, right? So what the key differences are, right, are the economic transmission. How do we move money from the company's balance sheet to the policy owner? Now watch this. This is remarkable. Am I sharing my screen, right?
Yes.
Okay. So this is the general account. Look at the net yield on mean invested assets, right? These are all, I don't know, within 20 bips of one another, right? Like North American, maybe even to 2024 to 4.92. So this is your general account, right? And you're investing in really long-term instruments, right? So there's a discipline here that a private investor doesn't get. But look, watch this. Watch this. So if you focus purely on guarantees, I have a whole life with guarantees, and I have an IUL with guarantees. They look remarkably similar. And it drives home the point that I'm trying to make, that both are backed by general account. Now, again, it further supports the point of different economic transmission, right? There's the surplus in the participating dividend. There's a derivative or index credit link in the IUL. They, again, structurally, they look very similar. Rick, Steve, anything jump out at you here? Anything you want before we get into some sales ideas? This surprise you?
Hey, what I would say, Anthony, is it at the core here, it doesn't. At the base guarantees, are there. They're very similar. They're probably more similar than I would have thought. So it's almost like an aha moment for me. What you're getting from the policy, maybe also on the IUL side, the non-guaranteed components of this. But if you go back to the basic foundation, they're very similar, but it's the upside you get from the others.
Yeah.
The client wants a little more go gas pedal. IUL, if you got a client maybe a little closer to the retirement years, hey man, I want to sleep at night.
Yeah.
A whole lot looks great.
Rick, that surprised you to see?
It surprised me a little bit on there, but I think without looking at everything that's built into that, it's hard to say exactly what comes into all that. But at the end of the day, the products are both, portfolio-based products, I suppose, right? They're on the balance sheet of the companies. So you would think they'll get there. Just depends on what the give-ups are at the carriers and to get that, right? So so I think, ultimately, you have to base your decision when you buy a product, not only on the guarantees, but what you think is going to happen from there, as well as client behavior. I think one of the things that's interesting with a whole life product is that you kind of just do things the way they're supposed to be done. If you do it right, it's kind of a contract between the carrier and the client, right? And if both people live up to expectations, you get what you paid for, right? I think if you had an IUL product, this is just my own opinion, I think if you had an IUL product and you illustrated it at, let's say, whatever the number is these days, 5.5%, okay? And you had a continuation of years where you were at poor returns on that, okay? I don't know that you would keep that product with just to get the guarantee piece that's on there, because I don't think that's really part of the sale. I think you're buying that product because you want to have the current performance and the upside protection on it. I think, so I think I'd look at that component as well. Like, there's a policyholder behavioral component of this whole thing, I think. I mean, no one's going to keep a whole life product that pays no dividends, okay, if they thought they're going to get dividends. And no one's going to keep an IUL product that doesn't live up to the expectations that they thought it was going to do when they bought it, right?
Absolutely.
So,
Absolutely. But structurally, I did want to show what's kind of underneath as the foundation of those two products and how similar they are. One thing I said to some of my associates at lunch yesterday, I said, look, IUL, whole life, right? It could be hotly debated. But what I've learned in my career is that the companies that are leaning into and wanting to stay active in the life insurance and distribution industry are typically creating, maintaining, and treating their policy owners significantly better than companies that are not. It's just that simple. If you believe New York Life is going to be issuing policies for the next 40 or 50 years, then you're buying into the fact that they're going to treat their policy owners properly. Okay. There are whole life companies that have demutualized, sold to private equity. They don't treat their policy owners fairly. Okay. They are not in the market any longer. North American, being a privately owned ESOP company, if you believe they're going to be manufacturing product 30, 40, 50 years from now, they're going to treat their policy owners properly. They're going to do everything they can to maintain caps. They're going to do everything they can not to pull levers to pull the I gotcha, right? It's a pattern. if you exit the business, you're going to be mistreated. If the company that holds your paper exits the business, you are going to be mistreated. So long term, you want to buy a company that you feel is committed long term to the marketplace. Now we have 18 questions. I'm gonna ask Steve and Rick, can we, after this webinar, take each one of these questions, divvy them up between the three of us and answer them and provide everyone the feedback that they've been asking for? Is that fair?
Sure.
Because I don't want to miss a couple sales ideas here, because these are really, really cool. And something Rick is about to show you, I think is groundbreaking when it comes to our industry. So Rick, talk to us about, so one question that I asked both of you to prepare, one answer to the question I asked both of you to prepare is, what are you seeing, where are you seeing the largest and most creative sales occur in your practice using your product as a solution? So Rick, let's talk a little bit about real estate investors.
Yeah, so one of the places where we see quite a bit of business is that there's people out there, whether they're real estate investors, which is kind of the key characteristic, if you will, but they can be people that invest in businesses and so on and so forth. But at the end of the day, there's people that have a lump sum of money. They want to put that money into a life insurance contract, normally as quickly as they can into that life insurance contract, and then they want to use it later for taking money out and doing different things. It's the old kind of be your own banker concept out there, if you want to call it that, but more on a higher scale, where we're talking about people that are doing, maybe buying an apartment building and they fix it up or whatever it is, and then they sell it, so they have a liquidity event. They put that money somewhere, okay, and then they look for the next deal to come out, and they take money out and do the similar type situation, right? So people are looking for a place to put that that's kind of tax advantage, has some tax advantages, as well as some investment advantages to them. So the way I laid it out is like, who would you know that wants significant assets, wants cash quickly? Because a lot of times, if you're in that market, you know that the banks ask a lot of questions before they're going to lend money, particularly if it's a situation where there's a lot of investors, or it's a property, let's say, that's run down and not in a condition that they want to finance. Okay, so you need someone who can get cash quickly, and then they want to have no acquisition cost to get it, right? You want to be able to call up and get that money quickly, no questions asked, no fees, no nothing, and still earn interest on it. And so we see a bunch of that. I'm sure some of you on the call have seen this, but so one of the ways that we structured that is we use a 5-pay life insurance product, because if you put money in year one, you create a modified endowment contract. So doing it over 5 years, which is kind of a niche for New York Life, because we can fund a whole life product on a guarantee base over a 5-pay. So you do a 5-pay whole life contract. This example here, I'm putting in $50,000 of base coverage with $100,000 of paid up additions on top of it. And so we end up in a situation where you got about 75% cash value in year one, fund that product for 5 years. At the end of 5 years, there's about $700,000. You have pretty much everything you put in and then some, and that becomes accessible cash value to you. You can take out through typically loans for this particular strategy. So you take a loan out, the money still gets a dividend because we're non-direct recognition. And then once you're done using that money for whatever purpose you're going to have, typically a refinance or something on a real estate project, they'll move the money back into the product. So we've been doing that for a long time, and that's not to say you can't use that for long-term yield, but to your point, Anthony, earlier about what is the niche, we're selling a lot of policies at New York Life using our premium deposit account, okay? And that premium deposit account allows someone to take one lump sum deposit, put it inside a life insurance policy, and then you get a discount because we credit interest on the premium deposit account, and then we fund those premiums automatically, which is nice because I like to tell people it guarantees the premiums, but also effectively guarantees your renewals. So it's a nice piece for the broker as well as the client. Anyone who sold a large life insurance policy knows the client typically asks 2 years later, why did I do this again? Can you remind me again? So the fact that it's all paid up front is great. And the thing that we wanted to kind of talk about that's new really here is now we have some lenders. We've been working with Wintrust a little bit behind the scenes, and Wintrust now has the ability to lend against the premium deposit account at New York Life and as a line of credit. So what happens is, unlike having to put the money into a policy and create a modified endowment contract in year one, you could put the money into the premium deposit account at New York Life, get a discount for prepaying all the premiums. Then you could reach out to Wintrust, who's the largest lender, I think, in the life insurance business right now from a premium financing perspective, and they have the ability to add a line of credit to that premium deposit account. So think about that. It's not a loan, it's a line of credit. So if you don't use it, you don't pay for it. But if you use it, you pay interest to Wintrust, and then eventually when that money's repaid, it goes back into the line is empty, but the whole time the premium deposit account continues to get the interest, and so you have access to, let's call it 80-85% all in when it's done of the money that's put into that life insurance policy. So it gets clients exactly what they want, which is a single payment into the life insurance structure with access to almost all the money that they put into that deal if they need it for some investment down the road. So I think it's a game changer, because a lot of premium deposit accounts, I know New York Life's, I don't know about other companies, but New York Life's premium deposit account, that money's inaccessible. So the trade-off for getting that discount up front is if you give us $1 million, then the balance of the money that doesn't go into cash values on the policy and is sitting in the premium deposit account is inaccessible. So now for the first time, that money becomes accessible for clients to be able to get out of the premium deposit account. So it lets you really maximize this strategy in a way that, we've seen it in one-offs, but not in a Main Street type situation where we can do this. So
Yeah, Rick, it is absolutely a game changer, right? Because if you want access early on, you have to create access within the cash value portion of the contract, right? And that requires blending or high hourly cash value riders or some form of artificial access. Drags long-term performance, lowers the economic earnings for the retail advisor. Right, here's an opportunity to park money in an interest-bearing account, for that matter. It's a fairly competitive interest-bearing account, and be able to access in the event opportunity arises. Okay, distressed commercial property, opportunistic, whatever you're into. Real estate is a great example. Full access day one to a very competitive line of credit without having to sit and wait for the cash value to accumulate to a meaningful dollar amount.
It answers a question when someone says, look, I would do, why don't people make these deposits year one? Because they're afraid of what's going to happen, what's going to come up next that they're going to miss out on because they did this deal. So now when you have larger premium deposit account type situations, clients can have the comfort of knowing, hey, I can enter into this transaction with the safety of knowing that if something shows up a year from now or 6 months from now that I want to get into, I can do that as well through the line of credit.
Appreciate it. Steve, same question. Where are you seeing the largest and most creative sales occur in your practice using your product as a solution?
All right. Hey, Anthony, and I see I'm looking at the clock. I'll do this pretty quickly. So, gang, I've got 2 quick things for you. If you like any of these things, call your light brokerage, your light brokerage marketer. Call me directly. I'll help you with the concepts, and I'll point you back to the right guys at light brokerage. 2 things I want to share. The first place where we are really seeing activity is business owners, whether it's business owners that have business continuation planning, buy-sell agreements, things like that. If you do that all day long, we have tools that you're going to like. If you know you have business owners and you want to go into that part and grow your business more substantially, let's talk. I'll make it simple for you. We have great resources there. We have a team that's really skilled there. The other place where the sale I was excited to share briefly is people typically think about IUL in the pre-retirement years for all the things we've been talking about, but people don't typically think about using an IUL in the retirement years. I would call this longevity planning. Say you've got a client that's in their mid-60s. Say they're worth $5 million. They're worth, or they're worried about market corrections, taxes, long-term care. I got kids I like, but I'm not going to start giving them my money yet. So what I would suggest is, and again, I'll do this really quickly. If you like this idea, let's talk. If I were to role play and say, hey, you got a $5 million client, let's take 1% of their assets per year. Let's de-risk those assets. Let's change the tax characteristics of those assets. We're going to move $50,000 a year on that $5 million net worth client. We're going to put it into a guaranteed IUL. This time we're going to use a guaranteed death benefit product. That's going to give the client the ability to have a buffer for taxes, no taxes on the money in the future. We got downside protection. We have liquidity from that death benefit for long-term care and health expenses. We've got liquidity provisions with return of premium should their investments fall short. And we've got the self-completing legacy plan if they don't need the money. So in looking here, thanks, Anthony, we start with a client in the mid 60s, 62, 50,000 a year. That's going to buy $1.3 million a death benefit guaranteed. What I would just say here is it's a great conversation to have with clients. That $1.3 million is available for death benefit. The 500,000 is available as a return of premium. And whether the client wants to do it or not, it's a great dialogue to have. And so, that person that says, hey, I don't need my policy anymore. The kids are out of the house is paid off. Hey, I would not go buy the ability to 1035 an old policy or look at this as asset diversification. Thanks, Anthony.
Well said. All right. Rick and Steve, we have some homework to do. We're up to 22 questions. All right. So we're gonna have to dig in this afternoon. Just very quick lightning round. When I poll plus delta, right? Like what was the best parts of the program? I'm getting overwhelming X and chats. Two things, home run takeaways. Steve, guaranteed tax-free income on an IUL. Okay. You cannot get that in an embedded VUL. So that does kind of overcome some of the objections of why would you pigeonhole yourself into an IUL when you can buy the same index on a VUL? That's because you can't. You get access to 8 different S&P and options, and you get the opportunity to pull the trigger on guaranteed tax-free income. Rick, home run takeaway, access to institutional fixed income and discipline through whole life, and then being able to leverage that using a PDA account for entrepreneurial purposes. That was the home run takeaway. Gentlemen, it's top of the hour. I can't thank you enough. This topic can be discussed for hours and hours and hours, but here we are shortly after 1 o'clock. Copy of the slides, a recording of the video will go out along with some additional content. Like here at Life Brokerage, we've built 2 things. We have the modeling tool that Steve shared that compares against alternative investments. And we've been able to build an entrepreneurial model where we can show the ability to take either policy loans or pledge the contract to a bank to create alternative investment assets. And it teaches the concept in real terms, and it tells the story from left to right on a economic model. So it could be very useful in your client presentations. So I want to thank you for participating. This was a lot of fun. Rick, Steve, thank you, gentlemen.
Thank you. Appreciate it.
Thanks, guys.
Be well all.